Hello, hello. We are back with yet another video. Today's video is on the capital asset pricing model. Now, if you recall from our last video, we talked about the dividend discount model, and we saw that to take any present value to a future value, we need to multiply it by the growth factor, which is 1 plus the rate of return, right? Now, usually we need to have a certain expectation about what this rate of return is or what we expect the rate of return to be. And for that, one of the tools that we use is the capital asset pricing model. One of the assumptions of the CAPM model is that investors are risk averse. What this means is that if you want me to invest in your venture or your company or take a certain amount of risk, I want to be adequately compensated. If that doesn't happen, I will not be willing to take risk. There are two ways we can think about the CAPM and sort of understand the formula behind CAPM. One way is the mathematical formulation, which involves graphs and equations. And if you guys want us to do that, drop a comment down below and we can make a video which explains CAPM through that lens. But today I will try to explain CAPM through a more intuitive approach. Though the mathematical formulation has its own place, and I appreciate it a lot. E bracket R is just another way of writing expected return. As a risk averse investor, what is the expected return that I'm looking for? Is it possible that I can get some return without taking any risk? Well, as a matter of fact, you can do that. And we do that through government issued securities, right? And the return that we get on government issued securities is often referred to as the RFR or the risk free rate. This is the return you can get from sukuks or government issued bonds. So I'm expecting to get at least the RFR. Going forward with our example, let's assume that we wish to invest in a more risky venture. For example, the stock market. Now we know that to invest in the stock market, we'll need a return of at least the RFR. Actually, we'll need a return of more than the RFR because if we're getting the RFR without taking any risk, why would we want to take on risk, right? Since we're risk averse. The question then becomes what is the premium that we want to invest in, for example, the stock market? Naturally, if you've been following along, I think you'd be starting to understand that we're basically looking for more than what the risk-free rate is giving us, right? So to enter into a riskier market like the stock market, we need a premium. And how do we get this premium? Well, this premium is the market return, and we subtract from it the risk-free rate. Again, because this is just what the market is giving us above the risk-free rate, which is our return for taking that specific amount of risk. One point though, this market return is the premium that the entire stock market will be giving above the RFR. So this would be the KSC hundreds return above a government issued bond. What about specific stocks? Well, we know for a fact that certain stocks are more volatile than the market, and certain stocks are less volatile than the market, right? And if you recall from our earlier sessions, the greater the risk, the greater the return. That's the rule in finance. And to capture this effect, we have what is known as beta. And I apologize for bringing Greek back into the equation, but it's quite essential. So the expected return that we get from CAPM then becomes the risk-free rate plus the beta times the market premium. The market premium being the market return minus the risk-free rate. Now let's look further into what beta means. To develop an understanding of what beta is, we first need to understand that broadly speaking, there are two risks: systematic risk and unsystematic risk. And we'll do this through examples. First off, let's imagine that there are two shops, one that sells milkshakes and one that sells ice creams. Now, the milkshake shop requires the blenders to be working for them to be able to make milkshakes. So there are two possibilities that either the blenders are working or the blenders aren't working. On days that the blenders work, the milkshake shop will earn a return of 20%. On days when blenders aren't working, they'll have a return of 0%. Now, on the other hand, the ice cream shop is not affected by the blenders. So if the blenders work, they'll still earn a return of 20%. And if they don't work, their return will be 20%. So either ways, their return is 20%. Now, blenders then becomes a firm specific risk since it only targets the milkshake shop. And a good way to hedge against this would be to buy shares of both the milkshake shop and the ice cream shop to protect yourself from that particular firm specific risk. Now, this firm specific risk is what we call an unsystematic risk because it is unique to that particular firm. Similarly, there are certain industry specific risks. Now, let's imagine that there is a third shop, the soup shop. We can bunch the milkshake shop and the ice cream shop into a dairy product industry. Both of them rely on milk, which is a key component. Now, on days that milk is supplied, the milkshake shop and the ice cream shop will earn a return of 20%. However, on days when there is no milk, they'll earn a return of 0%. Now, this is an industry wide risk. So, to diversify and save yourself from this risk which affects this industry, you will invest in the soup shop as well as either of the two ice cream or milkshake shops. This way, you can protect your returns because the returns of the soup shop on the days that milk is supplied and on the days milk is not supplied is 20%. Now, both of these industry and firm specific risks are what make up the unsystematic risk. Lastly, let's understand what do we mean by systematic risk or market risk. Now, imagine the marketplace has only two shops, the ice cream shop and the soup shop. If the next day is sunny, the ice cream shop will earn a return of 20%. If the next day it rains, the ice cream shop will earn a return of 0%. Vice versa, on the days that it is sunny, the soup shop will earn 0%, and the days it rains, the soup shop will earn 20%. Now, the weather is a market specific, the weather is a market risk, meaning that it affects both the ice cream shop and the soup shop. In the broader market, this would be a certain type of risk has an effect on all of the stocks in the market. So it would affect all of the stocks in the Pakistani stock exchange, for example. Now, in this situation, what would you do? Well, you cannot, through diversification, hedge against this risk. If we look at the industry risk sheet or the firm specific risk sheet, we see that, for example, in the industry risk sheet, we could invest in the soup shop and protect ourselves from the risk of milk not being supplied, the industry risk. Similarly, in the firm specific risk, we could invest in the ice cream shop and not be affected by blenders not working. However, we cannot possibly run away from temperature. It is a systematic risk, a risk which affects the entire system. And beta is the risk which captures only the systematic risk. Because again, as we've seen, we can get away from industry risk and firm specific risk, but we cannot possibly save ourselves from market specific risk. In finance theory believes that if you hold a portfolio of 20 to 30 stocks, you will have completely diversified away the firm specific and industry specific risks. However, you cannot diversify away your market risk, and thus beta is a compensation for that. To tie it up, the expected return that we should get from a risky asset is the risk free rate, which is the return that government securities offer us, plus a market premium, which is the excess that investing in that market is giving you over the risk free rate, multiplied by the beta, which is a stock's movement in relation to the market. And for now, I want you to understand this. And in the next video, we'll really get down into the nitty gritties of how beta is calculated and how it can help you in making your investment decisions. Stay tuned for the next video. Thank you.